and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. For the coming financial year, Economic Survey 2023 has predicted a sustained increase in private capex. The survey also quoted an Axis Bank report which showed that India Inc.'s capex increased to 3.3 trillion rupees in the first half of the current financial year. Now, this is a significant increase from 2.6 trillion rupees in the same period last year. Amid this recovery, CII President Sanjiv Bajaj had recently said that a pause by the RBI in interest rate hikes may spur private investment. So, what do experts think about this prescription and what other measures could boost private capex? Bhaskar Kumar brings you the answers.
इस साल के बजट में कैपिटल एक्सपेंडिचर में भारी बढ़ोतरी हुई है। इसके लिए 10 लाख करोड़ का प्रावधान किया गया है। मैं आज देश के प्राइवेट सेक्टर से भी आह्वान करूंगा कि सरकार की तरह ही वो भी अपना इन्वेस्टमेंट बढ़ाएं।
Days after PM Modi's call to action, on March 13th, Confederation of Indian Industry President Sanjiv Bajaj said private sector capital expenditure depended on consistent demand and needed a minimum return on investment. Revealing his outlook for FY24, Bajaj said that apart from ensuring economic growth, the continued increase in public sector capex would also create new demand. He said this would also help with private sector capex and provide the tailwinds needed for increased growth in coming years. Bajaj added that in the coming quarters, India was likely to witness a consistent demand curve, which was one of the prerequisites for increased private sector investment. Meanwhile, he said banks were also able and willing to lend now. So, the right triggers for demand growth were all that India Inc. was waiting for. And, according to Bajaj, interest rates were one of the biggest such triggers. In that context, he said that with inflation coming under control, India Inc.'s hope was that the Reserve Bank of India would opt for a pause on rate hikes. Such a move, according to Bajaj, would send a strong signal that it was now India's time to grow. In essence, the CII president has said that a pause in interest rate hikes would spur private investments. But that's easier said than done. While declining marginally from the January print, the retail inflation rate in February still remained above the RBI's upper tolerance limit of 6% for a second consecutive month. As a result, analysts have predicted another rate hike by 25 basis points in the April Monetary Policy Committee meeting. CPI inflation has remained above RBI's tolerance level in 12 of the past 14 months. Crucially, core inflation, the stickiness of which RBI Governor Shaktikanta Das has repeatedly warned about, remained above the 6% mark. Meanwhile, at present, the repo rate is at its highest since February 2019 at 6.5%. Data are also sending mixed signals on the prospects for increasing private sector capex. The manufacturing sector's aggregate level capacity utilization improved to 74% in the second quarter of the current financial year from 72.4% in the previous quarter. Meanwhile, the festival season too could not bring cheer to the economy this financial year, despite being largely COVID-free. Growth in private final consumption expenditure, which reflects demand in the economy, declined to just 2% in the third quarter. This was a sharp dip from 9% in the second quarter and 20% in the first. Data released along with the Q3 GDP numbers show that the post-pandemic pent-up household demand may have fizzled out. Against this backdrop, what do experts think about pausing the rate hike cycle to give private sector capex a boost?
We feel that it may be prudent to pause now and see how the growth and inflation dynamics evolve, rather than go in for another rate hike in April itself. However, the optics of inflation being above 6% may push a majority of the MPC members to vote for a hike in April. Now, in terms of the private sector capex, a pause and some amount of stability on short-term rates may actually help them to go in for faster decisions for capacity expansion.
A pause is certainly needed because the inflation prints that we are seeing has nothing to do with the demand side inflation push. These are because of elevated commodity prices, though they have come down, but they're still elevated, and it is because of external factors. The challenge here is that if we keep raising the rates as a follow up to the US Fed, then it is going to further crimp private investments. Therefore, the time has come to delink from the US Fed actions and go for a pause.
Also, are there any other measures that could provide a fillip to private sector capex?
For example, with the recovery that we've seen in airline passenger traffic, we're now seeing very large aircraft orders that are being announced by some specific airlines. So really, consumption has to be very strong for companies to be ready to invest large sums of money.
With the kind of capex allocations that are there, the only way is to move that capex allocation push and actual utilization of the capex allocation so that orders start moving out from the government side. If that front is taken care of, then the segments which are linked to the capex, like say railways related manufacturing or road related construction activities, that will lead to demand coming from the bottom as well as from the industry.
A number of economists have said that since the current consumption demand is not broad-based, sustaining its recovery would be challenging. However, in a media briefing following the release of GDP data in February, Chief Economic Advisor V. Anantha Nageswaran said high-frequency data showed that consumption remained strong. The Business Standard Morning Show episode dated March 9th indicated the same. Apart from the course of future rate hikes, how the situation develops on this front will also determine how enthusiastic India Inc. will be when it comes to increasing capital expenditure.
Three Indian movies were part of the final nominations for the 95th Oscar Awards. When the Oscar was announced, The Elephant Whisperers won the award in the documentary short film category and Naattu Nattu in the original song category. Though individual Indians have won Oscars before, this is the first time that an Indian production is winning the coveted award. So, what does this year's Oscar success mean for the Indian film industry? Let's find out.
Four individual winners, 3 nominations in the Best Foreign Language category, and an honorary Oscar for Satyajit Ray in 1992. These pretty much sum up India's presence at the Oscars till this year. But when the 95th Academy Awards were announced, a documentary short film and a song from India won the Oscars. Naattu Nattu, a song from RRR, directed by S.S. Rajamouli, won the award in the original song category, while Elephant Whisperers, directed by Kartiki Gonzalez, clinched the award in the documentary short film category. Also, in the documentary film feature category, Shaunak Sen's All That Breathes was nominated. Two movies that got nominated for this year's Oscar from India told stories about human-animal interactions in the shrinking ecosystem. Elephant Whisperers told the story of a couple, Bowman and Belly, who fosters an orphaned baby elephant named Raghu in Tamil Nadu's Mudumalai tiger reserves. The documentary explores the relationship between human and animal world in the scenic Mudumalai. All That Breathes failed to win the award in documentary feature film category, but the story of two brothers from northeast Delhi who took care of injured black kites was a touching spectacle. With Naattu Nattu winning the Oscar, the 95th Academy Award showcased the potential of the Indian film industry. With the advent of OTT platforms like Netflix, Disney Plus Hotstar and Mubi, Indian movies found a pathway to reach the international audience. With the help of subtitles, regional language Indian movies have earned accolades for their authenticity and uniqueness. Despite the dominance of Bollywood, South Indian movies were able to grab pan-Indian and pan-global attention. Movies like Kumbalangi Rights, Jelliket and Kantara from South India, Village Rockstar and Amish from Assam, and Hindi movies like Tumbad have bagged international recognition.
I think the streaming platforms have had an important role to play in certainly the availability of a almost a standardization across various Indian languages being made available. So whether it's Hindi or Tamil or Telugu or Kannada or Malayalam or Bangla or Punjabi or whatever, because of the existence of both dubbing files as well as subtitled files.
Apart from that, Indian big budget movies like Pathan and Bahubali earned massive collections from overseas theatres. Pathan's worldwide collection has already crossed rupees 1000 crore. Before COVID, KGF and Dangal also grabbed huge box office collections globally.
There will definitely be more attention by the global audience, specifically for Hindi films or regional films, and even short films or documentary movies for that matter. As I said, that gone are the days wherein you had only theatrical stars doing well overseas.
This year's Oscar will definitely inspire filmmakers from India. It is also a good omen for the Indian film industry as it is getting international attention. Hopefully for Indian films, the Oscar success will be reflected in the film streaming platforms and theatres across the globe in the coming years.
Despite FY23's divestment timeline being missed after the proposed stake sale in Hindustan Zinc turned uncertain, the Nifty Public Sector Enterprises Index hit an all-time high last week. So will the delayed divestment target take a toll on investor sentiment, or will PSU stocks continue their outperformance? Lavisha Darat gives you the answer.
As the government's offer for sale plans in Hindustan Zinc turned uncertain, it could miss its revised asset sale target of 50,000 crore rupees for the current fiscal year or FY23. Yet, the Nifty PSE index conquered a new all-time high of 4,550 mark last week. Analysts attribute this continued interest in PSU companies despite the near-term overhang to lower valuations and higher dividend yield. A higher dividend yield stock, they said, offers cushion to investors against downside in volatile times and assured them with steady flow of income. Therefore, analysts foresee the run-up in PSU stocks to continue over the near to medium term.
At Sharekhan, we have a positive view on public sector companies, largely due to attractive valuations. Many of these public sector companies also offer high dividend yields, which will give support on the downside. The growth outlook also for some of these public sector companies is quite attractive, especially companies in defense, railways, and our sector, where you have strong tailwinds. Lastly, we believe that there is upside for oil marketing companies also now. Given the improving trend in refining margins, also the decline in the under recoveries. Our preferred picks in the public sector space are Hindustan Aeronautical, Bharat Electronics, NTPC, State Bank of India, and this BPCL.
Nishit Masters of Axis Securities meanwhile said that power stocks will drive the Nifty PSE index's performance in the near term.
The Nifty CPSE index has hit an all-time high. We believe that this index can continue to outperform the overall market because the key constituents of the Nifty CPSE index, which are dependent or serve the power sector like NTPC, Power Grid, Coal India, or hydropower companies like NHPC and SJVN, should do well in the current environment where we are seeing increased power usage, growth in power consumption, and in turn higher capacity utilization, especially for thermal power plants. The companies which are part of the Nifty CPSE index are fairly valued, and there is a high probability that they might outperform the overall market in the near to medium term.
In the past 12 months, Hindustan Aeronautics, Bharat Heavy Electronics, Power Finance Corporation, NHPC and Bharat Electronics were the top 5 performers of the Nifty PSE index, surging up to 100%. In comparison, the Nifty PSE and Nifty 50 climbed 10.2% and 2.4% respectively during the same period. Overall, though the divestment timeline remains a key trigger to watch out, analysts remain positive on select PSU companies due to their attractive valuations and higher dividend yield. As regards today, investors will watch out for the European Central Bank's interest rate stance. Global cues, rupee movement and foreign fund flow action are set to dominate market trends on Thursday.
On 10th of March, Silicon Valley Bank or SVB in the US collapsed due to a bank run triggered by falling bond values of the bank as well as slowdown in the tech industry. So what is a bank run? Tariq Ahmed brings you the answer.
A bank run is a situation where a large number of depositors of a bank rush to its branches to withdraw money in a short span of time. Usually, the banks keep only a fraction of their total deposits in reserves as cash. So, when a large amount of money is withdrawn, the bank will run out of money. Nowadays, bank runs can also happen when a large number of depositors withdraw money through digital means. This is known as silent bank runs. Almost all the time, bank runs are triggered by concerns of insolvency. When the trust in a bank is broken, depositors will try to immediately withdraw their deposits, and this will spark bank runs. Most often, bank runs happen due to panic rather than real insolvency. Rumors about a bank can trigger panic among depositors and lead the bank to default. When multiple banks undergo bank runs at the same time, a financial crisis called banking panic occurs. That's why bank runs are also known as self-fulfilling prophecies. During the Great Depression in the US, when the stock market crashed, several bank runs occurred, triggering a banking panic. India too has a long history of bank runs since colonial times. In 2018, several reports of bank scams and the Financial Resolution and Deposit Insurance or FRDI bill triggered a near bank run situation in Andhra Pradesh and Telangana, where people rush to banks to withdraw their money. Banks use several methods to prevent bank runs. When there is a panic, banks often slow the process of withdrawing money either by physical means or by putting a withdrawal limit. Banks also borrow cash from other banks to mitigate the situation. When the depositors have confidence about a bank's solvency, bank runs will slow down. But in the current scenario, as most transactions are done through digital means, central banks ensure the small-scale depositors to prevent a bank run. Reserve Bank of India's subsidiary Deposit Insurance and Credit Guarantee Corporation provides deposit insurance of up to 5 lakh rupees. Before failing, Silicon Valley Bank was catering mostly to the tech industry, and a general slowdown in the industry caused panic among the depositors of SVB. Also, as the bank's asset value went down, it decided to sell some of its assets for losses. This led to a bank run and eventually a collapse.
I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
In September 2008, Wachovia, the fourth largest bank in the US, lost $5 billion in deposits, comprising 1% of its total deposits, when panic-stricken customers started withdrawing their money. That is all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.